Investment bubbles are nothing new. They're as old as human nature itself. But what's very new is the way we've had bubble after bubble after bubble in the last 2 decades, and also for completely separate markets to form bubbles together and then to burst together. In my book, I'm trying to explain why we are more prone to bubbles this way than we used to be. And I think it ultimately comes down to 5 factors. First of all, both in banking and in investing, principals have been split from agents. For example, in the stock market 50 years ago, more or less all stocks were traded by the individuals who actually owned them. Now, most stocks are being traded by funds managing them for somebody else. We all know that when you're dealing with somebody else's money, you'll tend to treat it differently from how you treat your own. Next, there is the concept of herding. Investment really now is an institutionalized industry. People work within it and they tend to congregate together around the same ideas, the same stocks, the same sectors. That way they avoid embarrassment, they won't do much worse than their competitors, they won't see their money leave to go to a competitor. But of course, if everybody is investing in the same thing, then bubbles are going to form where they invest. It's a dangerous phenomenon. Next, there is what I call safety in numbers. Over the last 5 or 6 decades, you've seen the growth of many theories in academia that put a precise number on how you could trade off risk and return, how you could actually measure risk. Now, those theories often, in many cases, make great sense. They come with plenty of caveats. People know that they're approximations, but their psychological impact is very important. If people think that they can put a number on risk, they will also tend to think that they can control that risk, and that will make them overconfident. It'll mean that they take too many risks. Next, there is the concept of moral hazard. It's another reason why people take too many risks, is if they believe there will be a bailout waiting for them if those risks go wrong. There were many very famous government bailouts of the financial system at the worst of the financial crisis in 2008, but in fact there had been a series of bailouts, a series of reasons for financial participants to believe that there would be help for them if things went wrong. Over the decades leading up to that, that growth in moral hazard plainly led to excessive risk-taking, speculative excess, and ultimately many synchronized bubbles. Finally, there's what I would call the rise of markets and the fall of banks. Again, half a century ago, the financial system was based around banks. Decisions such as whether you could buy a house, whether you could get a mortgage, or whether a small company could get a loan, rested with the individuals who worked as lending officers for banks. Now decisions like that rest with the capital markets. Capital markets are often a far more efficient way to do that, but they're also more prone to the swings of sentiment that you see in markets, to herding behavior, and that again means that they can contribute to bubbles. Now, what's alarming about all of this, I think, is that all of those factors do remain present even after the big crisis and the recession that followed it, that we've all lived through. I do think, therefore, that the risks that we will continue to be hardwired to create investment bubbles remain very much alive.